Our credit scores are typically reviewed whenever we make major financial transactions, buying a house, securing a loan, credit cards, renting an apartment, buying a car, right? So many other things. And it's important to figure out, how that works and, how it fits into our financial portfolio. So we're going to talk about how to calculate your credit score and what's everything behind it, right? I mean, the most well known credit score is the FICO score. Now, FICO calculates your score using factors like your payment history, your debt owed, length of credit history, types of new credit, and we're going to go over each of them briefly, talk about some of the key points, right? So, the first one that we're going to talk about is going to be that payment history. Now, whether or not you pay your bills and debts on time, it's going to make up about 35% of your credit score. Now, paying your bills on time is the best way to improve this portion of your score. Now, late payments will bring down your score, while consistently paying promptly is going to keep it up there. Lenders, they want customers who they think are going to pay back their loans on time. So, positive payment history means you're more likely to secure loans. If you notice that your credit report shows an overdue or missing payment, consider calling, your creditor to see if they will remove it from the report. If you can, work out a payment plan, work out a deal, whatever you need to do, right? One way to avoid missing due dates for recurring expenses, like, think mortgage, car loans, student loans, right? Set up those automatic payments, right? So you'll never miss it. It'll always just instantly be taken out on the day it's supposed to. So the next thing we want to talk about is going to be that debt that you owe. Now, how much debt you owe in relation to how much credit you have makes up about 30% of that credit score. Now, this figure is also called your debt to credit ratio, or your credit utilization. If you routinely use up all of your available credit by maxing out multiple credit cards, it can result in a poor debt to credit ratio. Now, to improve your credit utilization, just work towards paying down your credit card debt, right? The ideal debt to credit ratio, you should never be over 30% for each account. So let's say you've got a credit card with a $2,000 credit limit. Now, this means you should aim to never have a balance more than $600 in any given month. So your first goal should be working towards that 30%, and then work towards paying them off monthly. You can also call your creditors and ask for a credit line increase as you work to pay down your balances. Raising your credit allowances can help lower your overall debt to credit ratio, which again, that's what these lenders they want to see. They want to make sure you're not using all of this money all the time. Then one of the big ones is going to be, the length of your credit history, right? How long have you had established credit, right? Maintaining long running accounts shows lenders you're good at managing debt long term. Now, this is one area where you can't actively improve your score other than maintaining positive habits and just waiting for time to pass. One thing to remember is if you cancel a credit card, that credit history with that card, it's gone as well, right? So it's usually why you hear a lot of people tell you not to cancel a credit card, right? Because that credit history will just disappear. Now, there's also different types of credit used, right? And the types of credit you currently have, also called diversity of credit or credit mix, this is about 10% of your score. Now, having various types of accounts, mortgages, car loans, student loans, credit cards, this is going to signal to lenders that you can handle different types of debt. Now, you can diversify your credit in a bunch of ways, right? But if you don't already have one, a credit card can add another type of account to your report. Getting a car loan or a mortgage, now that's going to show lenders you can handle balancing payments from multiple sources of debt while still being financially responsible. Well, there's also new credit. Now, this final like 10% of your credit score is just going to factor in how many new accounts you've opened in the past about 6 months. So you may have heard of hard inquiries, right? Now, this is when a creditor formally runs your credit report. Now, these hard inquiries typically only occur when you're about to open a credit account. Think a loan, a credit card, a mortgage. So they really don't happen that often. Experience says that people who have several inquiries on their credit reports in a short period are more likely to overextend themselves and default on their debts. That's not a good sign to creditors, right? So it's important to not take out too many lines of credit at once. You'll want to make sure there's some time in between when you apply for loans and credit cards. This general consensus is about 6 months. So if you're going to open multiple, at least wait 6 to 7 months in between each one, minimum. And not only do multiple hard inquiries look bad to creditors, but they also affect your credit score. As an example, one inquiry can decrease your credit score by about 5 points. Multiple inquiries in a short period may have a compounding effect. So be really careful about anything that you're going to do. Now, one of the bigger questions that you probably even you might ask, or someone like me, I get asked all the time, is do I need to keep a balance on my credit card to improve my credit score? Well, no. You don't need to keep a balance on your credit cards to either improve or maintain your score. In fact, it's best to pay off as much debt as possible each month so you don't have to pay any interest or fees. Right? As we talked about, your credit utilization ratio should be lower than 30%. So, in this case, a zero balance is just as valuable as a low balance. Now, you don't need to always owe something on your credit cards for utilization to register. Paying off your balances regularly, if you're able, it's not going to hurt your score. And of course, the last thing to talk about is now that you know how these scores get calculated, right, and how to improve each category, you're starting to think, well, how long is it going to take to improve my credit score? There is no one size fits all answer to this question because there's so many factors that make up your score. However, by following some best practices like paying your bills on time, keeping your debt levels low, you'll likely notice changes in your score relatively quickly. You could see improvement as little as a month or two, right, depending on how aggressive your efforts are. But for most people, it's going to take a few months or a year or even better for significant changes to occur. Just stay positive and proactive, and that's going to help you get closer to that goal of having that excellent credit that you would love to see, that 750 plus, right? So just work on it little bit by little bit. Keep those best practices, right? And just stay disciplined, right? You'll get there. It's just a matter of when, right? I hope this is some good information for you guys, get you on the right track, get you in the right headspace. If you enjoyed it, I'd appreciate you hitting that like button. If you're not subscribed to the channel, what's stopping you? Go ahead, hit that subscribe button. But, I'll see you guys in the next video. Y'all be safe.